I'm still trying to wrap my mind around the situation. If I was Kevin Costner, what my objections would be to what you just said. And so obviously he wants to keep the land, but in this situation, he would have to sell it, right?
Yeah, but let's talk about what he also could do. So now the $1 billion exit is now outside the taxable estate, and the smoke clears, the buyer's gone, he's out of that piece of land, but he could turn around and joint venture partner with the trust, and let's say go buy another $100 million piece of land next door or the next state or whatever, right? From a different buyer, from a different seller, I mean. And now he can still have his ranch, right, that the trust joint ventured partnered with him to purchase. So this is the beauty of the DST 2.0 is you don't have to be fully retired. You can also partner with the trust. Now, it couldn't be his primary home. It'd have to be a legit, like, you know, he's running a ranch business, he's running a business. Now, he might buy the parcel next door and just pay tax on that one and establish his house, you know, like on a couple acres. And then right next door to that is the business. Hey everybody, Brett Swarts with Dan Palmer today. We're covering Montana ranch tied to Yellowstone Universe hits the market for $16.3 million. Kind of some cool news with the marketplace. You know, Dan, the big challenge with people is estate tax, right? So I don't know if you've seen the show. We can go through the show's kind of plot, but you know, I'm wondering, you know, if this thing were worth, the actual land in the show makes it seem like it's worth like $1 billion, right? But right now it's 16.3 million.
Well,
so
they own all of it back then, supposedly. So
that's true, right?
It's
so
a
maybe
little ranch, but they own like the big thing. If you watched 1883, that pre-movie, they kind of just claimed that whole area.
That's a good point. Yeah, but I think it's good to cover both sides. So when you use like a 1.0 versus a 2.0 with the trust, right? And then why each one covers which. And in this scenario, even if someone were selling the first $16 million tranche versus like selling, let's say, $160 million tranche, what's the differences, right?
Yeah,
so
the
do you want to?
tax is going to be the piece that comes into play with the larger exit.
Right, so let me just read this here. So Two Feathers Ranch, a 357-acre estate in Darby, Montana, has hit the market for $16.3 million. The ranch appears briefly in the Paramount series Yellowstone in a single scene lasting just over 2 minutes. Okay, interesting. Okay, so this is just one part of it. By the way, this show has some of the most beautiful scenery that you've seen in like shows ever. So this is what's going on here. So the proper is represented by.
Let me set the scene for you, Brett. So. If for all of our viewers who watch the show, Kevin Costner gets ambushed, if you remember, and they have a huge shootout on the road. And he is like riddled with bullets, and all of his kids are freaking out because they don't know if he's going to make it. And if he doesn't make it, it blows their whole world up. So, Brett, explain how it blows their world up.
Yeah, okay, exactly. Because what's going to happen, he's the last, his wife had already passed away, I don't know, 15, 20 years prior to this. So Kevin is the owner of the land, right? And although he has a living trust and he's planning on passing it down to Beth, the daughter, and the other two sons, or at least one of the sons, maybe the other son's probably not in the will anymore after all the turmoil. But the estate debt tax is going to kick in, and that's going to crush the estate tax. In fact, there's a scene also previously to that show or that episode where Beth is explaining this to her dad, basically like the death tax. So the death tax basically is anything above 15 million single, 30 million married, as of the new Trump tax plan that came out. By the way, when Kevin was shot in that season, that was over 2 years ago at least. It was still in the exemptions of about 7 million married, about 15 million single, okay? So what's at stake is a 40% death tax. So let's just do the math. Let's just say that land was worth $1 billion. They never really quite get to like what the land is really worth. So that would mean $1 billion minus the exemption at that point, because he's still single, being Kevin Costner, of about 7 million. So what? So you're $997 million, is that right? Yeah. And, or $993 million times 40%, which is the death tax. So roughly about $400 million of a death tax. This is what's at stake. And so, yeah, they're like, hey, keep this guy alive. So Dan, what would be the solution? What could we have done, had, a couple weeks prior to that, let's just say, what could we have done?
Yeah, so the concern for them is, Dad, if you sell the land, we can get all the money and we're going to get taxed, but if you die, we're going to be forced to sell the land. Why does him dying make them have to sell the land?
Because it kicks in the death tax, right? So when you die, and what's ever inside of your taxable estate, and so in this scenario, let's say about $1 billion, okay, then they're going to assess the government and say, hey, Kevin, or Kevin's estate, it's $1 billion times 40%, save the exemption. That's the tax. That's just what it is. Within 9 months, it must be paid. And so this is what people typically do. Number one, they buy a lot of life insurance. But $400 million is a lot of life insurance. That's a lot. Okay, so, it's really expensive. Two, they try to gift it away. They, hey, Beth, I'll gift it to you, or this other son, I'll gift it to you, I'll gift it to you, grandson, all this stuff. But they run out of kids, and they can only gift so much per year. They do like spousal trust where they, it's called SLATs, spousal lifetime access trust, so they can get a little bit more out. But the point is, it's so hard to get that much amount out, and so that's the big challenge. And I think a lot of even real estate brokers or financial advisors, oftentimes they're just focusing on a stepped up basis, and they're forgetting about the death tax. And so now you can give it all the way to charity, which is great, but not every family is 100% charitable, right? So this presents the solution that we have. So Dan, talk about it, the 2.0 version and how it works.
Yeah, so in a situation like that on Yellowstone, we have this huge problem. It's literally the premise of the entire show. Kevin Costner could set up a 2.0, which is, it's a less flexible form of the 1.0. But the benefit is it gets all the money outside of your estate upon the death. So when Kevin Costner dies, that full $1 billion is outside the estate for the death tax. Kids can step into his shoes. Now, the 2.0 is going to be partial principal, partial interest payments in perpetuity until death, based on the actuarial tables of the government. So there is a little less flexibility there, but the benefit side is that $400 million, Brett, that you're talking about now is outside the full billion's outside the state, but the 400 million no longer is relevant.
You nailed it. So I'll also say it again in maybe a little slightly different way. We need to get the billion outside the taxable estate before Kevin dies. Otherwise, the $400 million of the estate is going to be assessed. And so what does that mean? Well, that would have meant Kevin needs to sell the land. So you got to go find $1 billion buyer. This is not something you can just, let me just put it in let me just assign it to this trust. So let me just gift it to a trust. Like, no, you have to sell the land. You have to find $1 billion buyer. So we'll call it, I think there was one season where this $1 billion buyer wanted to buy it all from him and create the condos and the ski resort. So let's say we go find that guy. So hey, find that guy, and then he has $1 billion, and then Kevin is still alive, really important, but we set up a trust in between that buyer and Kevin, okay? And then what happens is the sale first happens to the trust. So this is the DST 2.0 we're referring to. Sells it to the trust for $1 billion, okay? And then the trust turns around and sells it to the ultimate buyer for $1 billion. So he has the land, he goes, builds all this stuff. So the land is definitely out. Kevin's got to move somewhere else. Maybe he moves to Wyoming, maybe he moves to Idaho, who knows? He moves somewhere else. Maybe he goes to the 7 ranches or whatever it is in Texas, whatever that's called.
4 sixes.
4 sixes, there.
That's right by me, so.
4 sixes, baby. He gets there. He's all happy because he knows that the $400 million is forever eliminated. It's not only that, Dan. Hopefully he's safer in Texas now, right? But second, because he's out of all the turmoil, that $1 billion, let's say it had grown over his lifetime to $2 billion. That is also outside the taxable estate. And so it's not just the initial $400 million elimination. It's now times 2, $800 million elimination. Okay, that is the power of the DST 2.0 without any charity, life insurance, or gifting required. And one sale in one day, has to have a third-party buyer. You have to work with a third-party trustee. That's part of what we do. You can eliminate the estate tax forever. Forever, okay? So super powerful way to eliminate estate tax. Dan is correct. The payment will be less flexible than the 1.0. because it's a different tax code, different rules, and it'll also be partial principal, which means cap gains tax, partial interest. Now the 1.0 can be a little bit of both, but most people just do interest-only payments or partial interest payments, whereas this other one has to be a bit of both. So That's how it works. Now the kids are the beneficiaries of the 2.0, and they inherit it estate tax free, and guess what? Capital gains tax free. So back to the whole concept of, well, I think I should maintain the stepped up basis with the 1031 exchange. Well, why? If you can do the 2.0 and eliminate your estate tax. Now we would say maintain a 1031 if you're below 30 million married, 15 million single, and you want to be owning these assets and these properties. And in fact, we work with families that have a bit of both, 1.0 and 2.0. Sometimes you have two trusts, that's okay, right? But really we want to figure out which tool, which trust do we want to use, which version to solve what problem, realizing that not every a trust or every solution is going to solve every problem, but you can stack different solutions to solve different problems. Any thoughts on that, Dan?
Yeah, I'm still trying to wrap my mind around this situation. If I was Kevin Costner, what my objections would be to what you just said. And so obviously he wants to keep the land, but in this situation, he would have to sell it, right?
Yeah, but let's talk about what he also could do. So now the $1 billion exit is now outside the taxable estate, and the smoke clears, the buyer's gone, he's out of that piece of land, but he could turn around and joint venture partner with the trust, and let's say go buy another $100 million piece of land next door or the next state or whatever, right? From a different buyer, from a different seller, I mean. And now he can still have his ranch, right, that the trust joint ventured partnered with him to purchase. So this is the beauty of the DST 2.0 is you don't have to be fully retired. You can also partner with the trust. Now, it couldn't be his primary home. It'd have to be a legit, like, you know, he's running a ranch business, he's running a business. Now, he might buy the parcel next door and just pay tax on that one and establish his house, you know, like on a couple acres. And then right next door to that is the business. That's fine. As long as they're different parcels, that's totally cool. You just can't have your primary tax deferred. So that's just a little nuance there. Does that make sense, Dan, what you could do?
Yeah, totally. Yeah. Yeah, it's so interesting when you have these shows and you kind of put them into a real world context and try to think through how a tax strategy like the Deferred Sales Trust can be a huge benefit for people here in the real world. Yep. And so I know there's a lot of clients we deal with day in and day out, and they're trying to solve this very problem.
Yep. And so let's touch on the 1.0 real fast, because I did promise that we would do that. And this actual land sale here, again on for Yellowstone, the actual, you know, one of the scenes that they're shooting is like a $16 million land sale, and we have found that for the first 10 million in any calendar year, the 1.0 is the best because they have what's called 453 interest charge above and beyond 10 million per married couple per calendar year. So this being about a $16 million sale, our initial likely structuring for this would be the first 10 million to go into a 1.0, and then the second, you know, the extra 6 million to go to a 2.0, unless we could stagger the sale over a different calendar year, okay? Now, why is that? Well, the 1.0 is much more flexible for the payout, meaning it could be partial interest, it could be interest and principal, it could be interest only, and it can also be, it can be delayed for a couple of years too. Technically, the 2.0 can be delayed for about 2 years as well, is the general recommendation by the tax attorneys. But the point is, it's like a water faucet that can be turned on and turned off, so more flexible. So if you're an entrepreneur, this is powerful. If you're just a higher income earner, this is powerful, because your most expensive thing that I've heard you'll ever pay is what you don't know. And number two is taxes, okay? The most expensive tax you'll likely ever pay is income taxes. So both of these trusts can defer income tax to a certain extent, but the 1.0 can do it even more so, okay? And the reason is because you don't have to necessarily have a full interest payment. You can really kind of drop that, and typically about half. So that's a interesting way to structure this for Kevin as well. If Kevin were only selling a $16 million piece of land, he could structure a little bit of both, but the 1.0 could be that extra value add for the income tax deferral. And so what we're really talking about here is tax flow, not just cash flow, and finding ways to position a structure in such a way in a sale to be able to compound the ability to grow wealth, all within the U.S. tax code. This is what this is why they pay us the big bucks, Dan, to figure this stuff out and to structure it and deliver it, right?
Yep. So summary: 1.0, 5 million individual, 10 million for a couple. Basically, you can take full interest payments no payments at all. I think the benefit of the 1.0, Brett, also is that because you don't have to take partial interest, partial principal, all of that interest can just compound and grow within the trust. Tons of flexibility in terms of generating and building wealth with that. 2.0, anything above that, 5 million individual, 10 million threshold, going to be partial principal, partial interest, but everything's outside of the state tax threshold. So for your kids, that's the power piece.
Yeah, you nailed it. Right, you got it. And so the 1.0 is per calendar year, so add that. So it's about 10 million per married couple per calendar year or single. And then the other 2.0, no matter what the size of the 2.0, whether it's a million or 10 million or 100 million, it's always going to be the same type of payment structure. By the way, the 2.0 also works for stock, public stock, really big. 1.0 does not work for public stock, but it works for any other asset from that point on, whereas the 2.0 works for any asset, including public stock. So that's a little nuance there. Minimum size we like to see is at least $1 million net proceeds, $1 million gain. That's the minimum. If you're selling a primary home, we like to see $2 million net proceeds, $2 million gain because of that 121 exclusion if you lived there the last 5 years. Real quick, fees, about 1.5% to set it up on the legal fee one time to 1.25 depending on the size of the deal. And then trustee fees, somewhere around 85 basis points to 2 points, depending on if you're using a financial advisor. Just kind of depends on the size of the deal. That can get, you can get a little bit better than that depending on the size of the deal. So those are just some of the nuances of these two things. Last thing, you get to work with a trustee. Now that could be a downside for some people, but on our side it's an upside. We're going to add value to you, bring a team of professionals to help execute this. But you have to give up some controls. Important to understand. But all that being said, if you want to learn more about this, you just go to capitalgainstaxsolutions.com. If you're a professional advisor, business broker, M&A advisor, financial advisor, CPA, we want to work with you to help your clients on this. And we're on a mission to help people build capital gains tax exit plans, estate tax exit plans for large assets so they can multiply freedom and impact. We appreciate you listening. He's Dan Palmer. I'm Brett Swarts. Go to capitalgainstaxsolutions.com to learn more, and we'll talk to you soon. Bye now.